Hi everybody, it's Clarke Camper with the May edition of Wall Street in Washington. This month I'd like to talk about three things. First, efforts to increase the federal debt ceiling. Second, a glimmer of hope in the transatlantic harmonization of derivatives regulation. And third, potential SEC market structure initiatives. First, in terms of efforts to increase the federal debt ceiling, it's interesting. I've heard a lot of people liken the situation to the old adage about Venus and Mars, that Washington and the business community are like Venus and Mars, you choose which one. But the point is that they are from different planets and doomed never to understand each other. I get that. I think that analogy is okay as far as it goes. But in point of fact, I think it's really unfair to both the business and the Washington community, because I think each of those communities get each other better than that adage would lead you to believe. For instance, the business community, why has there been little market reaction to the possibility that the debt ceiling might not be increased and that the federal government would default? I think there's been little market reaction because the business community understands that it's extremely unlikely that the debt ceiling won't be increased in a timely fashion. Likewise, the political community, they're carefully watching the markets, and as long as there is little market reaction, I think it's very unlikely that politicians are going to move any faster than they need to move. So what does that mean? Crystal balling it, I'd say that we will see an agreement on increasing the debt ceiling at the very end of July or early August, because that's the date at which Treasury Secretary Tim Geithner has said that the federal government would officially default on its loans. The one thing that could cause a change in that is, indeed, if the markets start to react negatively, I think you'll see politicians move very quickly to increase the debt ceiling. But again, I would say, absent an unusual market reaction, I think you'll see an agreement at the end of July or early August. Moving on to my second topic, and I said a glimmer of hope for those who are hoping for harmonization of transatlantic derivatives regulation. For a long time now, there's been a fair amount of what I would call happy talk among regulators and politicians on both sides of the Atlantic about the fact that ultimately the derivatives rules would be very similar, at least substantially similar. The difficulty for those of us who watch the space very carefully is trying to figure out how does that actually happen. There have really been two pieces to the puzzle. One is timing of consideration, and the other is substance of the derivatives rules. In terms of timing, the U.S. has been far ahead of the EU in terms of setting derivatives rules up until recently. And what we've seen over the last couple months is that the U.S. has essentially relaxed its time frame for implementing the Dodd-Frank rules. The rules were to be implemented by most of them by July this summer. Politicians now of all stripes, including Barney Frank, one of the authors of the acts, have said that there's no rush to get those rules done. There's some efforts in the Congress to actually relax the rules officially so that the implementation date would be moved back to the end of 2012. In point of fact, I don't think that really matters because functionally the pressure to issue the rules quickly is off, and regulators in the U.S. are taking their time, I think, wisely in terms of implementing those rules. So again, in terms of timing, we're seeing a confluence of the U.S. and the EU, who is likely to start really meaningfully implementing their rules next year or the year after. In terms of substance, we've seen a significant development. On May 17, there was a bipartisan letter from the New York congressional delegation that focused for the first time very directly on the need to harmonize rules between the U.S. and the EU. It was a very specific letter. In fact, I believe that it said that the rules ideally should be identical. Now, that's probably not going to happen. But the point is, the reason that it's so significant is for the first time you have very credible bipartisan attention focused on the need to harmonize rules. As I said, it's a glimmer of hope. It's not the actual path to full harmonization, but it certainly helps to sketch out the beginnings of that path that everybody knows we really need to get on in terms of making sure that the rules on both sides of the Atlantic are substantially similar. Finally, turning to SEC initiatives in the market structure area, many observers, including me, I confess, had thought that the SEC would be so overwhelmed fairly by its implementation responsibilities under Dodd-Frank, in addition, I should say, to its ongoing enforcement activities, that we thought that workload would mean that the SEC could not meaningfully pursue any initiatives in the market structure area, at least not really meaningful ones. I think that still it's probably true, but over the past few months there have been some developments, and I think we should keep our eye on those. Specifically, senior SEC officials, including Mary Shapiro, have talked and I know are focusing on potential market structure initiatives. For instance, there's discussion right now about a trade at rule that effectively would require trading venues to post their prices and to ensure that trades were executed at the NBBO, that is the National Best Bid and Offer. That would have a very significant impact in terms of moving trading from the unlit venues into lit venues. Another area in which I know there is consideration of policy initiatives is around high-frequency trading, both in terms of potentially imposing market maker obligations on high-frequency traders in times of market stress, and also consideration around possible cancellation fees for for high-frequency traders that have inordinately high cancellation rates. Now, the bottom line is, stepping back from those, do I think those initiatives are likely to be proposed? Actually, I don't. I think that they're very complicated. They're likely to be controversial initiatives. And so at the end of the day, I don't expect that those initiatives will be proposed. But it is noteworthy in that the fact that the chances are significantly greater than zero that such market structure initiatives would be proposed, again, is a noteworthy development and something to keep watching in coming months. So with that, I'll wrap it up. We'll see you next month on Wall Street and Washington.